You've probably heard the claim, set up a Hong Kong company and pay zero tax. It's one of the most repeated statements about Hong Kong, and one of the most misunderstood. So let's answer it honestly, right at the start. Yes, it is legally possible for a Hong Kong company to pay 0% profit tax, but it is not automatic, and it does not apply to every business. It depends on where your profits actually come from, and you have to claim it properly and support it with evidence. In this video, I'll explain how Hong Kong's tax system really works in 2026, the real rates, the real deadlines, the real costs, and the real timelines, so you can plan on facts, not myths. How Hong Kong's territorial tax system works. Hong Kong uses a territorial tax system. This is the foundation of everything else in this video. Only profits sourced in Hong Kong are subject to Hong Kong profits tax. Profits sourced outside Hong Kong are generally not taxed here, even if the company is incorporated in Hong Kong and even if the money is received in a Hong Kong bank account. The key question is never where your company is registered or where your money sits. It is, where were the profits actually generated? That word, sourced, is where all the complexity lives, and it's the reason the 0% claim is sometimes true and sometimes very wrong. The profits tax rates in 2026. First, what you pay when your profits are taxable in Hong Kong. Hong Kong uses a two-tiered profits tax system for corporations. The first 2 million Hong Kong dollars of assessable profits are taxed at 8.25%. Anything above 2 million is taxed at 16.5%. One detail worth knowing: in a group of connected companies, only one entity can use the lower 8.25% tier. There is no VAT or sales tax, no capital gains tax, and no withholding tax on dividends. So even in the fully taxable scenario, Hong Kong remains one of the most competitive tax systems in the world. That part of the reputation is well-deserved. Your first tax return, the timeline. Now, before we get to the exemption, here's a timeline every new founder should know. Your company's first profits tax return doesn't arrive immediately. The Inland Revenue Department normally issues it around 18 months after your incorporation or the start of business. You then have 3 months from the issue date to file that first return, together with audited financial statements. In later years, the standard deadline is just 1 month from issue, although extensions are commonly available under the IRD's block extension scheme when you file through a tax representative. Mark that 18-month point in your calendar the day you incorporate. It arrives faster than founders expect, and the audit behind it takes time to prepare. The Offshore Profits Exemption: process, costs, and timeline. Now the part everyone asks about, the Offshore Exemption. Officially, an offshore profits claim. If your company's profits are sourced entirely outside Hong Kong, you can claim that those profits are not subject to Hong Kong profits tax. If the claim is accepted, the effective rate on those profits is 0. Here's how it actually works, including what it costs. First, the claim itself has no separate government fee. You make it in your annual profits tax return, supported by a clear explanation of how your business operates. Second, the IRD reviews the claim. They will usually issue detailed questions, where your contracts are negotiated and signed, where your suppliers and customers are located, where your team physically works, and where day-to-day decisions are made. You normally have 1 month to respond to each enquiry letter. Third, be realistic about the timeline. A straightforward, well-documented claim is often resolved in around 3 to 6 months. If the IRD needs more evidence, expect 6 to 12 months. And complex cases with several rounds of questions can run longer. And even an accepted claim can be revisited in later years if your operations change. Finally, if you want certainty before you file, you can apply to the IRD for an advance ruling on the source of your profits. That does carry a government fee, 45,000 Hong Kong dollars, which covers up to 23 hours of IRD officers' time, with additional hourly charges of roughly 1,730 to 2,650 Hong Kong dollars if your case takes longer. For most small companies, the annual claim route is sufficient. Advance rulings mainly suit larger or more complex structures. What the IRD actually looks at. So how does the IRD decide where profits are sourced? The guiding principle is often called the operations test. What did the company do to earn the profits, and where did it do it? For a trading business, the focus is where sales and purchase contracts are negotiated and concluded. For a service business, it's where the services are actually performed. For e-commerce and digital businesses, the analysis looks at where the core operations happen, not just where the server or platform is. And a genuine warning: if you, as the founder, live in Hong Kong and run the business from Hong Kong, an offshore claim becomes very difficult to sustain. The exemption fits businesses whose operations genuinely happen elsewhere. It is not a label you can attach to any Hong Kong company. Common myths and mistakes. Let's clear up the most common myths. Myth 1. Hong Kong companies pay no tax. As you now know, only offshore-sourced profits can be exempt, and only through an accepted claim. Myth 2. If I claim offshore, I don't need to file anything. Wrong. You must still file your profits tax return with audited financial statements every year. And late filing has real consequences. Penalties typically start at 1,200 Hong Kong dollars for a first offense and escalate quickly. Continued failure can bring a court fine of up to 10,000 Hong Kong dollars, plus up to 3 times the tax undercharged. And the IRD can simply issue an estimated assessment, taxing you on profits it estimates for you. Not filing is a compliance breach, not a tax strategy. Myth 3. Once approved, it's approved forever. The IRD commonly re-examines offshore positions every few years, so your documentation needs to stay current. Myth 4. Offshore in Hong Kong means tax-free everywhere. If profits are offshore to Hong Kong, another jurisdiction may have the right to tax them, for example, where you actually live and work. And for larger multinational groups, additional rules, such as the foreign-sourced income exemption regime, can apply to certain passive income. Good planning looks at the whole picture. Summary and key takeaways. To summarize, Hong Kong taxes only Hong Kong-sourced profits at 8.25% on the first 2 million Hong Kong dollars and 16.5% above that. Your first tax return arrives about 18 months after incorporation, with 3 months to file. Profits genuinely sourced outside Hong Kong can be exempt, legally 0%, claimed through your tax return at no government fee, typically reviewed within 3 to 12 months, with an optional advance ruling costing 45,000 Hong Kong dollars if you need certainty upfront. And regardless of any claim, you must file every year. Penalties start small, but escalate to fines plus treble the tax undercharged. So, do Hong Kong companies really pay 0% tax? Some genuinely do, but it's earned through real offshore operations and proper documentation, not through the act of incorporation itself. How CapTime can help. At CapTime, we help founders understand how Hong Kong's tax system applies to their specific business model before problems arise. We support clients with bookkeeping, audit arrangements, and profits tax filing, including preparing and supporting offshore claims with the right documentation from day one. If your operations are genuinely offshore, we help you present that clearly. And if they're not, we'll tell you honestly, so you plan on solid ground instead of a risky assumption. If you're setting up a Hong Kong company or unsure how your profits would be treated, book a free 15-minute consultation using the link in the description. No credit card, no obligation. Key takeaway: Hong Kong's tax system is one of the most founder-friendly in the world, but it rewards businesses that understand the rules, not those who assume 0% is automatic. Know where your profits are sourced. Know your deadlines. Keep your evidence organized and get professional advice for your specific situation. Thank you for watching. If you found this video helpful, please like and subscribe for more practical content on Hong Kong company setup, tax, and compliance. See you in the next video.